Hi there, my name is Aaron Dunn. I've been working within the SMSF industry now for around 20 years and have become recognised as one of the country's leading SMSF experts. I'm a CPA by trade and an SMSF specialist, recognised as the highest accreditation within the SMSF industry. Utilising the related party acquisition rules to acquire business real property is a popular strategy for SMSFs that provide an opportunity to lease back the premises of the business on an arm's length basis. This strategy not only provides a highly tax effective outcome within the superannuation environment, but can include significant exemptions and concessions on any transfer of the property into the SMSF, in particular around the small business concessions. To understand how the small business concessions can apply, let's take a look at the following example. John and Jane Citizen run a successful retail clothing business, turning over around $1.2 million in revenue each year. The factory is owned jointly by John and Jane, having been acquired in 2004 for $400,000. They've always operated the business from this property since it was originally acquired. The property is now valued at around $700,000 and they have no debt over the title. Having met the related party acquisition rules, John and Jane can now look to transfer the property into their SMSF as a contribution, which will trigger a capital gain of around $300,000. To deal with this capital gain, John and Jane can utilise two of the small business CGT concessions to eliminate this tax liability. The first step for John and Jane is to determine whether this transfer meets the basic conditions. These include a CGT event must have happened in relation to the asset that the taxpayer owns. The event would otherwise have resulted in a capital gain, and at least one of the following applies. One, that the taxpayer is a small business entity for the income year. Two, that the taxpayer satisfies the maximum net asset value test, or that the taxpayer is a partner in a partnership that is a small business entity and the asset is an interest in an asset of the partnership, and that the asset is an active asset. Now note that if the asset is a share in a company or an interest in a trust, one of the following must apply. The taxpayer is a CGT concession stakeholder in the company or the trust, or that the entity that owns the shares or interest in the trust passes the 90% small business participation test. To be a small business entity, John and Jane must be carrying on a business and have aggregated turnover of $2 million or less. Now in this case, John and Jane meet this requirement. The other basic condition requires that the property must have been an active asset. That is, that John and Jane must have used or held ready for use the CGT asset at all times during the period required by the law. So it's important to note here that an asset can be active even if the taxpayer does not carry on a business themselves, provided that the asset is used in the business of the entity connected with or affiliated with that taxpayer. So a common example of this is occurring where the taxpayer owns the business premises and makes them available for use by a business entity which is controlled by the taxpayer, or where that taxpayer and that business entity are controlled by the same third person. And this is certainly the case here with John and Jane and the transfer of this business real property into their self-managed super fund. So the amount of time for which an asset must be active for it to pass the active asset test depends upon whether the asset has been owned for more or less than 15 years. And in this regard, the period begins when the taxpayer acquires the asset and ends at the earlier of either the CGT event or the cessation of the business. Looking at the facts here with John and Jane, as the property has been owned for less than 15 years, the asset must be an active asset for at least half of the relevant period. Now, having purchased the property in 2004 and utilised it for the entire time within their business, John and Jane will have satisfied these requirements. Now, having met these basic conditions, John and Jane can look to reduce the capital gain by applying either the 50% general CGT discount, which must be applied first. We can then look at the small business 50% reduction, and we can then also look to apply the small business retirement exemption. After applying the general 50% discount, the small business 50% reduction can be applied, effectively therefore reducing the original capital gain by about 75%. It's important to note that John and Jane may choose not to apply this 50% reduction if they choose to. The ability to ignore this reduction is an important consideration subject to the level of non-concessional contributions that are available with each fund member. The remaining amount of the capital gain here can then be reduced and/or eliminated using the small business retirement exemption. A capital gain here may be disregarded up to a lifetime limit of $500,000 if the basic conditions are satisfied and the proceeds from the CGT event are used in connection with that taxpayer. In this case, the retirement exemption will be used to disregard a capital gain to the extent that the taxpayers here, their lifetime limit of $500,000 is not exceeded. So in John and Jane's case, will be required to contribute the exempt amount into their SMSF as they are under 55 years of age. So by virtue of this factory being contributed in specie into the fund, an amount of this transfer can be applied towards their CGT cap.